Good morning, and thank you for having me. It's a pleasure to be here. My name is Cindy Estis Green, and Kalibri Labs is a new industry benchmarking and analytics company. We have the most robust database in the hotel industry for right now for the US, but we're moving internationally starting next year. And I'm going to talk to you about very different things than you just heard in the earlier presentations. We're going to move to more commercial issues. And I'm going to talk about how digital disruption has changed the hotel industry. This is with or without COVID. And then we add COVID on top of it, and we've got some challenges ahead. So I'm going to give a lot more numbers and be a little bit more quant-oriented than the past speakers. But I think I'm going to head off by first talking about digital disruption and how this will impact the whole hotel industry, from economy through to luxury. I'll give you some baseline numbers on what 2019 looked like as kind of a reference point. I'm going to talk about how the pandemic affected the industry overall, because it had some pretty significant changes to the underlying business mix that may persist for some time. And then I'm going to talk about how this commercial leisure split, which we didn't pay as much attention to before, becomes a primary focus for us as we go through the recovery. So I'm going to talk fast because I have a lot to share, so bear with me. There are many gatekeepers in our industry now. Everyone is familiar with, Google, and in the Facebook, and in the travel space, of course, we have Expedia, Booking.com, and a lot of the online travel agents. When we look at how these gatekeepers have kind of entered the industry and played a role, you can kind of look at, these are the market cap rates for the values of these companies. And you can look at the traditional hotel companies, Hilton, Marriott, IHG. If you add up their market value, it adds up to the equivalent of approximately one Booking.com or one Airbnb. So a lot of these big tech companies have extracted value from the marketplace and play a role where they will kind of be, as I say, gatekeepers, where a lot of the business that comes in, they're dominating at the top of the sales funnel. And as far as the hotels and the hotel operations, the question is, if you're lower down on the food chain, what control do you have and how much is it going to cost you? And that's really what it comes down to. So as we look at digital disruption, I'll describe it in this way. When I first started in the hotel industry, all of the distribution-related discussions were really about the shopping and the buying. How are consumers getting information, and how do they actually book? What's actually happened now is there's much more of a focus on the customer journey. So it isn't just the shopping and the buying. It's the arrival, the eating, the drinking, the staying, and the paying. And a lot of these tech companies, Google, definitely at the top of the list, but the OTAs and even the hotel brands are trying to create tools for consumers to be able to have the convenience of being able to track their entire customer journey from the shopping and the buying through to the staying and the paying and so on. But a lot of these tech companies they're like toll booths. So they provide these services, but then in exchange for access to those consumers, you pay advertising funds or fees, or you pay some other kind of fee that would give access to that group of customers. So if we dig a little bit deeper and we say, well, what is that, that shopping and buying? We used to have consumers that would go straight to what I call the stay brands. They would get information, they would make their bookings. We now have a category that I call the booking brands that have kind of intervened, and when somebody says, oh, I'm going to travel, they might go to Google, or they might go to Expedia instead of going to an individual hotel, or instead of going to a brand or some other kind of direct stay partner. So from the shopping and the buying point of view, we've had these booking brands enter the picture. But we've also had intervention on the arrival, the eating, and the drinking. So for instance, I was with somebody a couple of months ago who was staying at the Hilton Crystal City. And they said, oh, look on my phone. I just got dropped off by Uber at the Crystal City, and I just got this email or text that came to me to rank the trip, and then also to suggest restaurants near the Crystal City Hilton to be able to figure out where he's going to get his lunch. At the same time, he said, oh, I just got another text from the Hilton offering for me, if I need any help, I can contact Stephanie at the front desk and get, if I need towels or any other kind of question. So when you think about it, you've got Uber who's gotten into the hotel and talking to this hotel guest who's saying, hey, I can help you with other aspects of your journey, the arrival, the eating, and the drinking. And you have the Hilton who also is in contact with this guest, but a little bit more passively. And when you think about why would Hilton be only just saying, oh, if you need anything, let me know, but Uber is ready to put menus in front of you and actually get you to do something and take an action. And the difference and the reason why Uber can do that is they've got data for merchandising that Hilton doesn't have. I mean, the guest location, the past buyer behavior, local options mapped to the hotels, menus of participating restaurants. It takes a lot of data and a lot of infrastructure to do that. But that's the kind of thing that Expedia's trying to do, and Google's trying to do, and Uber's trying to do, and lots of others. And from a hotelier's point of view, to participate in that process, it's not going to be free. So you're either going to pay a fee to get access to those customers, or you're going to pay advertising fees to get in front of them. But this customer journey is changing how consumers are actually interacting with different partners and what's getting in front of them and what information is available to them. When we look at the stay experience, we've got things like mobile key, and we've got information on dining and attractions and other things. So again, a lot of the companies, the hotel companies are doing this, as well as the Googles of the world, trying to get information in front of the consumer so that they can kind of service the full convenience of their customer journey. So that stay experience is right now controlled internally within the hotel, but again, that can be merchandised as well. Then we've got the paying. And all of a sudden, we have this new category. It's sometimes called fintech or financial technology. I just noticed last summer there was a European company that stepped forward that has back-end financial services, but they decided to bolt on a front end related to travel. They launched it. It's called Stays, and it's actually meant to compete with the online travel agents. And they did it all on the back of financial services where they're already handling all the payments, and now they're going to offer different services on the front end. So what does that mean for hoteliers? Does this give other options besides online travel agents to get access to consumers? And then to further expand on financial technology, Booking.com actually announced not long ago that they're going to create a fintech unit, and they're going to handle all the complications of travelers who go to different countries and currency exchange, and what is that money worth if you pay today but you're traveling later, handling all of the financial back end on that. So there's many aspects to the customer journey, and there are many companies who want to get in the act, and from a hotelier's point of view, we just have to be mindful of control of those customers and how much it's going to cost us. So, Google and Facebook clearly at the top of the funnel and absolutely having tremendous control in the marketplace. Airbnb has been going after business travelers pretty extensively for the last 3 or 4 years. And we've got Kayak, just again this past summer, is launching a full corporate travel solution. So there's a lot of these companies trying to get at smaller and medium-sized corporate accounts that used to kind of come in more traditionally through the travel management companies. So what does all this mean? I'm going to launch into a series of data slides now. I'm going to give you a sense of what happened kind of baseline 2019, what happened with the pandemic, and what's going on going forward. I'm going to give you some forecast data. So again, everything comes down, in terms of digital disruption, everything comes down to control over that customer and how much it costs you to get it. Because we have to get our customers, and if we're paying all these intermediaries in the path before the customer actually comes to the hotel, or you're paying intermediaries while they're at the hotel because someone else is controlling that customer journey, then we just have to keep that in mind, because the cost of both acquiring the customer and retaining them has been going up as a result of the digital disruption, and we need to be mindful of that. So the database that we work off of, we have a database of 35,000 hotels. We track bookings, so we have all of the folio data, rate category, channel, cost of acquisition. So the database that we work off of is very large. We're actually looking to expand our small chain and independent presence, so happy to talk to anyone here about that. But this database enables us to see across right now. I'm going to report on US data. And if we look at what's happened since 2015 through 2019, so pre-COVID, we've had steady growth in RevPAR to the point where every year looked better and better, and everyone was feeling pretty kind of fat and happy. But there's a metric we track called revenue capture, which is really how much do we keep of what the customers pay. So once we pay commissions, retail commissions, wholesale commissions, transaction fees, channel costs, any sort of loyalty program that you may be participating in, there's 15 to 25% of the cost for acquisition that has to be removed from that. That revenue capture number has actually been coming down every single year. So we've lost 25 to 40 basis points each year in customer acquisition and retention. So this is all related to the digital disruption and the increased cost in the marketplace. So if we look at 2019, we can see for the overall US market, all chain scales, brand.com was just under 25%. The OTA business was 16%. When we move into 2020, we had about a 15% uptick in direct bookings, a lot related to the pandemic and concerns and questions people had. Brand.com dropped slightly, but that's mainly because the property direct, because so much more came directly to the property. Call in, walk in, drive up, that sort of thing. OTA business ticked up slightly to a little over 17%. And then through October of 21, we've got brand.com now back on a pretty heavy growth trajectory. OTA grew to about 19% of the US market, but a lot of that, if you look at the group percentage, it was as low as 8% for the last 2 years, which is not a surprise probably to anyone in the room. Normally, the group business is about 15% across the US. At the upper upscale and the luxury tier, it's closer to 30 to 35% generally. But overall, group business was cut by more than half, more like 75%. So when we look at how the business has developed in terms of costs relative to revenue, in that same 2015 to 2019 period, guest paid revenue grew at a very healthy pace, 17% over that time frame. All of the other costs, commissions, loyalty costs, channel costs, grew a little more slowly, so did not detract from the revenue, the profitability. OTA commissions grew more than twice as fast. So you can substitute for OTA, put in the Google and all of the other players that are coming into the market. Whether the OTAs remain or others take over, it's still a pretty substantial cost that we're bearing as an industry. So if I look at what's been happening in this chart, the gray line is 2019, the red line is 2020, which was kind of the COVID year, and the blue line is this year. So you can see that that blue line is still well below the gray line, which was 2019. So in occupancy, we're still quite a bit below. This is a 4-week trailing average for the full year. And through November, you can see the average rate. We actually, starting in the summer, the average rate across the US actually exceeded 2019 levels, dropped a little bit after Labor Day, and actually came back up. So we're still struggling, though, with volume in a lot of markets. So if I give you kind of the picture, 2019, the RevPAR for the overall US, if you look at that bottom row, about $87. 2020, it dropped by 52%. So RevPAR came down to $42, which is unthinkable that it would get that low. We expect we're going to end the year somewhere between 60 and 65. Right now, we're saying 64. For RevPAR for this year, which is a huge improvement, but we're still trying to get back to 87. And we expect next year to be somewhere between close to 75, depending on how things come in. We're still at about a 73 expectation. Again, we're still trying to get back to 87, so we still have a ways to go. And there's a reason why that gap still exists, which I'm going to get into. So if we look by chain scale, you can see the blue column represents 2020. This is a percentage of 2019 number. So the upper upscale and luxury were a third of 2019 levels last year. This year, we expect the upper tier to be a little over half 2019 levels. And we expect by next year, the upper upscale and luxury to be between kind of 70 and 75% of 2019 levels. So you can see economy and mid-scale, again, most people have observed this, have already exceeded 2019, but the gap is at the upper end of the market. If we look at location types, you can see that the rural areas and interstate, that kind of more lower, where most of the lower end economy, mid-scale properties are, again, is already back to 2019 levels. It's in the large metro areas that we're running so much below. We expect this year to be about 60% of 2019 levels in large metro areas. That's like the top 50 markets. And by next year to be close to 80%. So again, in terms of return to 2019 levels, we're still looking at 2023 and in some markets 2024. One of the silver linings, though, is those shoulder nights, which for my entire career, shoulder nights, Sunday and Thursday, have always been the worst and impossible to fill, except in resort settings. Shoulder nights, Sunday and Thursday, are now second only to weekends. And that's a really great trend. And I think the length of stay has also grown. So much more people, they can work remotely, they can work Thursday, Friday and Monday somewhere else. We're getting longer length of stay, which is really encouraging. If we look at the occupancy by chain scale, again, if we look at independence, which is the black line, or luxury and upper upscale, most of the audience here, they were at the top of the market in 2019. And now the bottom, that blue and red line that's way below, that is luxury and upper upscale. So they will be lagging for sure. However, when it comes to ADR, the story is much more positive. For the most part, and this data shows 2019 through 2021, for the most part, rates have come back very close from the summer onward, very close to 2019 levels in almost all chain scales, which is really exciting and encouraging. So the culprit behind the gap and behind what's been missing, again, not a surprise to anyone in this room, is pretty much commercial or business travel. So we had corporate and group that is just slower to come back, and it is coming back, but it's just more gradual. And a lot of the big corporate accounts are, restricting spending and, all sorts of reasons for restricting their return to the market. So this data that you're seeing here shows actually from 2015, we decided to split between commercial and leisure and look at what the patterns have been. Like, has commercial really dropped off, and how much has it really dropped off over time? In the US market, the commercial business, which is both transient and group, when I say commercial, so it includes government, it includes anything that's commercially driven, was 53% of the total revenue in 2019. 47% was leisure. However, you can see where we had the drop-off for COVID, and then you can see where we've come back early this year. This is points of occupancy. We still are not quite, even with leisure, not quite back to the levels nationally that we were. 40 points of occupancy coming from leisure, and only 25 points from corporate, or from commercial, where normally it would be more like the mid-30s. So that commercial business is just a big hole, and it's a big gap, and until it comes back, we're not going to see the numbers back to 2019. This chart is kind of the most telling. So the red columns that you see are the commercial business, and the blue is leisure. That's not a political statement, so anyone who thinks it might be. So if we look at 2020, those red columns were more like 20 to 40% of 2019 levels, and that black line at the top is 2019 levels. By 2021, the blue columns were pretty sort of rising close to that 2019 level, which is our leisure business. But the red, even by the end of this year, is still only 70% of where we were in 2019. And our expectation for 2022 is for commercial to get maybe close to 80%, but we're still going to have a gap. So just looking, we track 334 markets, 975 submarkets, and just aggregating this and looking at where the gap is on commercial and leisure, the overall US market, again, was about 53% commercial. We dropped off. By the end of July, we were at 25% down in terms of commercial business across the US. Top 50 markets were over 30% down. Mid-sized cities, which is the markets 51 through 100, was 24% down on commercial. Small city and towns only 17, and rural and interstate only 8%. So if you wonder why they're back, it's because they didn't have the dependence that the large markets did on the commercial business. So their business came back because the piece that was missing didn't really affect them. So just to give you an example, in Los Angeles, we can see this data shows just 2019 through present. We had the red is leisure and the blue is commercial. Los Angeles is only about 49% commercial, so it actually is more leisure than anything. And normally it's 50 to 60% leisure and more like 30% commercial. We're down to 45% leisure and 22% commercial. So again, the business is we have this big gap to get from 22 points of occupancy back up to 30 in order for Los Angeles to actually return. And if we look at all the submarkets, there's huge differences. We track 16 submarkets in LA. From the lowest one, which is downtown, is running 54% of 2019 levels. And the best submarket in LA is LA North, so areas north, is almost 100% back to 2019 levels. So even within a market like Los Angeles, the gap between the worst performing submarket and the best is pretty wide. If we look at one market, we'll take Santa Monica because we're here. As of November, it was performing at 57% of 2019 levels, which is it was the second lowest overall. And it's expected to maybe get up to 70 to 80% of 2019 levels. So any market that's dependent on that commercial business is still having to wait until that business comes back. And if you want to, this is Santa Monica broken out by rate category. That blue and that orange line at the bottom is corporate and group. The orange is group. 30% of 2019 levels. So guess what? Of course that business is missing, it's just not there. And 50% of corporate business. So as long as there's that big gap, even if the other business exceeds 2019 levels in terms of leisure, we're still missing a piece. And that piece, until it comes back, we're not going to get back to 2019 levels. So just to summarize, performance varies tremendously by market and by submarket, so be cautious about looking at averages because you really need to know where you're operating and where your portfolio or your hotel is. The dependence on commercial is the biggest driver of recovery. So if you're dependent on commercial business, you're going to have a much longer wait. So when people say, when is the hotel industry going to recover, it's not very meaningful except when is your market going to recover, when is your submarket, when is your hotel actually poised for recovery. And group is a huge constraint in the large metro markets, more even so than corporate. We do have some silver linings. Longer length of stay is encouraging, the uptick in shoulder periods. Leisure has contributed more than its fair share, more than its previous share, and ADR strength is really encouraging. From a luxury upper upscale point of view, the variation by market is tremendous. It's just so wide. You have to really look not just at your market, but your submarket. I mean, you can't just talk about Los Angeles. Santa Monica has its own story that's very different. You really have to look very closely, not so much at comp set, but at least at submarket. Leisure has by far overperformed, making it a shorter road to recovery to regain that commercial. And any of the major markets that have had a reasonable distance to a fairly large population have obviously performed better because they've been able to convert some combination of commercial and leisure. That a remote work from home kind of thing has really helped with that longer length of stay. And at the upper tier of the market, that probably will become a sustainable new source of business, which is great because some of that commercial business may never come back, but I think it will be compensated in other ways. So I want to thank you for your attention. Thanks for having me. And anyone who wants to ask further questions, I will be around the rest of the day. Thank you very much.